Thank you all again for taking the time to be with us this afternoon. Okay, I'll first introduce my colleagues Steve Brudos and Ryan Bergen. Both will be joining me for the discussion today. Steve is an investment analyst specializing in fixed income markets, while Ryan, joining us from our Minneapolis office, is a portfolio manager specializing in equity markets. Both have tremendous knowledge of their respective asset class, and I'm certainly delighted to have both with me today. So Steve, Ryan, welcome, and thank you for being here. Equity markets were up strongly on Friday last week and are up again today, but prior to that, equity markets struggled a bit in 2022. So we will spend some time discussing that today, but let's not forget that 2021 was a very good year for most asset classes. So again, before we address the recent market volatility, we wanted to quickly recap 2021. In dark blue to the left of the slides here are the different segments of the bond market. As you can see, TIPS, or Treasury inflation protected securities, and high yield, municipal high yield and corporate high yield, had a good year last year. However, the most interest rate sensitive segments of the bond market did not, as higher yields put downward pressure on high quality bond prices. Equities in gray to the right, on the other end, performed really well in 2021. With maybe the exception of emerging markets, which was pressured by Chinese stocks, which suffered from a regulatory crackdown, especially in the tech sector, but also a property crisis. Real assets in light blue to the far right also produced very strong returns last year. This is no surprise, as real assets, think real estate, commodities, natural resources, equities, are assets that tend to be highly correlated with inflation. And inflation was a big story last year and continues to be a big story again this year. Steve will actually address that in more detail in a minute. So that was 2021. 2022 has so far been a different story, especially in equity markets. So let's take a closer look at that. What we've done here is break up the four main equity categories shown on the previous slide between value to the left in dark blue and growth to the right in light blue. We did that to highlight the fact that beneath the surface, not all stocks are performing the same way in 2022. As you can see, it's been a bad year so far for growth stocks. Technology stocks, the largest sector within growth, has been hit particularly hard. Value stocks, on the other end, although down also year to date, have fared much better. Financials and industrial stocks are good examples of value stocks. Value stocks are often found in mature industries. They are called value stocks because they typically trade at lower valuation multiples compared to growth stocks. Growth stocks are stocks of companies that are growing fast, but that are also trading at high valuation multiples. In our opinion, reality is setting in here in 2022. As we had expected, investors at this point are no longer willing to pay sky-high multiples for growth stocks, especially in an environment that has recently been defined by higher inflation, higher interest rates, and more recently, a more hawkish Federal Reserve as well. These are simply not the conditions that have historically favored growth stocks. Steve, I'll ask you to jump in here. Investors had in the past couple of years been able to bet on an easy Fed that would make sure the cost of money stays low for some time, but things have changed in recent weeks. Why is that, and should equity investors be concerned?
Sure, thanks, Jan. While we have seen volatility picking up with the Fed preparing to tighten policy, historically, if we look at the beginning of tightening cycles, it has not typically been a weak environment for equities. In fact, in the past, stocks have continued to move higher in the early stages of rate hike cycles, typically as economies are usually fully recovered and really are growing enough to support tighter policy. So what is different this time around is the speed of the central bank and the adjustment and subsequent sharp increase in interest rates, which has led to a little bit of an increase in volatility and the correction that we're seeing. So as the next slide shows, inflation has been, one of the root causes for the quick adjustment that we're seeing in monetary policy, as it's really finally caught the attention of policymakers at the Federal Reserve. So for most of last year, the Fed saw inflation as mostly transitory. It expected things like energy prices, auto prices, and goods which were really affected by supply chain disruptions to fall quickly once the surge in demand had peaked. Well, these prices have taken a bit longer to come down than the Fed had expected. And at the same time, we've seen more persistent or stickier contributors to inflation, such as wage pressure and shelter continuing to pick up. So the chart here on the right shows CPI inflation peaking soon around 7%, with core CPI, expected to peak in the second quarter a little over 6%. The theme here is that both measures are really expected to come down in 2022 and in 2023. And as inflation is likely to come down, the Fed may not need to change monetary policy really as much as it's currently being priced into the market. And this would, provide support for both the stock and bond markets. So the next slide illustrates just how much of an adjustment in policy rates has been priced into the market. And if there's any Fed watchers out there, this is a tool that really anyone can access online. It's from the CME Group, and it's useful to gauge how the market is pricing in future rate hikes and tighter policy. So this bar chart is showing the probabilities of where the Fed funds rate will be at the end of this year. So looking at the chart, the 4 bars on the right indicate over a 60% probability of 4 or more interest rate hikes this year. So as soon as last fall, there was a 0 probability of even 1 rate hike in all of 2022. So it has really been the speed of this market adjustment that has been the driver pressuring yields higher and increasing market volatility. But again, as inflation is likely to come down, we think the market may be getting a little bit ahead of itself here. So we haven't talked a whole lot about the bond market yet, but as the next chart shows, the net effect of higher inflation and the Fed really embarking on a rate hiking cycle has led to higher rates across the curve over the last 12 months or so. Now we've been positioned well for this in portfolios. So after bonds rallied with interest rates falling from 2018 to the start of the pandemic in March of 2020, we have reduced interest rate risk. We sold bonds that had done really well during that time period and allocated more to shorter term bonds and global credit structures that really are less sensitive to rising rates. We did believe that once vaccines rolled out and economies opened back up, that we would certainly see inflationary pressure and strong growth putting upward pressure on bond yields. I mean, there was just enormous pent-up demand. Consumers were staying home, they weren't spending. At the same time, they were receiving stimulus checks. So our portfolios really have been positioned well for this move higher in interest rates. And we've outperformed the broader market as a result, as we've seen bond yields rising, like the 2-year, the 5-year, the 10-year US Treasury yields all shown here. They're all up over a full % from those 2020 lows. And, something to keep in mind going forward is that ultimately, higher rates do lead to higher returns for bond investors. And yes, we are getting some short-term pain here, which again, we are positioned well for. but ultimately over the long term, higher yields, will result in higher returns and income for savers and investors. So let's get back to equity markets here, and I'll let Ryan kind of talk about the fundamentals of the market, which are the main drivers of long-term equity returns, and how we look going forward from a earnings and growth perspective.
Thanks, Steve. I'll start by saying from an equity perspective that we do acknowledge the market's concern over sustaining above trend economic growth and in turn, sustaining above trend earnings growth. This is because of two themes. First, and I'll lump these together, inflation and the Fed, like Steve discussed, and second, the impact of COVID variants. Now, as for the Fed, the biggest risk there might not be just that the Fed is expected to raise interest rates, but that if it hikes rates more aggressively than currently anticipated, it could bring economic growth expectations down considerably. As for the COVID variant theme, Omicron is now having an impact on estimated first quarter GDP growth. Growth to start 2022 is expected to be soft due to the spread of the variant, which has constrained economic activity, both starting last month in December and continued into this month, across the entire world. There is evidence, however, that US COVID cases and really even cases in countries where Omicron was first reported, that those cases are rolling over. And for even a longer period of time, we've been seeing that lockdowns have been continuing to decrease across the world. So as you can see in this next chart, each of these major global regions shown here are expected to grow their economies pretty significantly this year, well above potential growth rates, otherwise known as long-term average growth rates, represented by the green diamonds. So, barring the Fed becoming overly aggressive with increasing rates, we think economic growth later this year will be better than what we expect in the first quarter, driven by increasing corporate expenditures, high consumer demand, as we've seen a high level of savings accumulated since the start of the pandemic. As you noted, Steve, companies are restocking their inventories, and that was already happening last quarter, and is an indicator the supply chain issues have started to ease. And then we're seeing banks looking to expand loan issuance. So there really is a lot of good, in the backdrop. As we look to the next slide to discuss corporate earnings, which are tied to economic growth, as I discussed on the prior slide, I'll note that fourth quarter earnings results for the S&P 500 have generally been positive. Now, the percent of the companies beating estimates is so far lower than the average we've seen in recent quarters, and the magnitude of the earnings beats has also been less remarkable, which is probably another component behind the market volatility. But this is against a backdrop of high earnings beats last year that were frankly unsustainable and should be expected to naturally come down. So this phenomenon of blowaway earnings results going away isn't a surprise to us. Specifically, still 79% of S&P 500 companies that have already reported their fourth quarter results have in fact beat analyst expectations. Now, for those reporting weaker than expected results, it's mostly been attributed to higher costs like wages. And importantly, though, I'm going to stress this, not because of weaker sales tied to economic growth. And analyst earnings growth estimates for the full year 2022, as is shown by the upper right squiggly line in the chart I'm showing, have been increasing for both the US and international companies. Now, over time, of course, GDP growth, revenue growth, earnings growth will all move closer to historical averages, but we still think that is several quarters away. For now, though, rising forward earnings should provide ongoing support for stock prices, even with the Fed raising interest rates. So we do remain bullish on stocks, particularly value stocks, which, as Jan has shown, have done well and held up well against growth stocks this month, and also small cap stocks. And we like both of these asset classes, given their very attractive valuations and their ability to outperform other areas of the stock market when interest rates are rising.
There's no doubt, Ryan, that good economic growth and rising, as you said, forward earnings estimates should provide support to equity markets. But what about the conflict between Ukraine and Russia, which appears to be escalating quickly? How should investors think about that?
Yeah, I guess what I'd say, it's very difficult for anyone to predict the next steps in the Russia-Ukraine situation. I mean, as much as we investment professionals would like to have an answer for everything, I certainly don't know how this plays out. But what we do frequently see is global stock markets experience short-term volatility during periods of geopolitical concern. In fact, looking at major geopolitical events going back several decades in this chart, the average drawdown of the S&P 500 has been only 4.6%, sustained over an average period of only 20 days, which is then followed by an average of 43 days for the index to recover and return to pre-crisis levels. In all, on average, it's taken only about 2 months for markets to work through these events. Let me maybe share some specific thoughts on the current situation from a client portfolio perspective too. I think it's fair to say international stocks are the most vulnerable in the near term to an escalation. I'd also add that arguably Russia's biggest contribution to the global stock market is in the form of energy production and therefore energy prices. Now, we have already seen oil prices steadily rising over the last several weeks. The price of crude has already touched $90 a barrel. And certainly all of us have noticed the higher gas prices too. And if there's an escalation, it is quite possible those energy prices could spike sharply higher yet on fears of less access to oil and natural gas, though, some of that may already be priced into the market given the volatility that we've seen. So I guess I'll finish up by saying, as history has shown us, very resilient global equity markets eventually look past such conflicts. They continue their long-term trend higher, and we think there's no reason that will be any different today.
Thank you, Ryan. I think that's a great historical perspective, and as your chart shows here, there have been many geopolitical crisis events over the years, but almost every time, as you said, markets have initially sold off, but recovered, and often very quickly. I want us to expand on this topic a little bit more. So now with the time that we have left together, let me bring some historical perspective as well on market corrections in general. Now, we all know that equity market corrections are part of the investment journey, right? But still, when we are in the middle of one, like we are today, it feels uncomfortable, right? It feels unsettling. The chart here provides some historical perspective on what every equity investor should expect in any given year. On average, historically, markets experience 3 pullbacks of 5% or more and 1 pullback of 10% or more every year. Some will even say that this is like predicting that all the leaves will fall from the trees between Labor Day and Christmas Day. It is an annual average event, so it's meant to happen. So when it does, no one should be surprised, right? Or worse, panic about it. 15% plus corrections happen every 3.5 years on average. And nastier corrections of 20% plus happen, as the chart shows, every 6.3 years on average. The 20% plus corrections tend to be associated with recessions. In fact, looking back, the only time in the last 50 years, the US stock market fell by more than 20% outside of a recessionary environment was in October 1987, Black Monday. For stocks really to go down more than 20%, corporate earnings need to fall, and that almost never happens unless there's a major economic downturn. And we're not forecasting a major economic downturn ahead. To start with, as Ryan discussed, earnings remain solid. Banks are lending, businesses are spending, and households are still sitting on a ton of excess cash. In addition, the Fed, in our opinion, will not be overly aggressive in tightening monetary policy to the point where they would kill this expansion. And although, as Ryan discussed, we don't have a strong view on how the crisis between Russia and Ukraine will unfold, we get comfort. We get comfort in knowing that historically, crisis events come and go. If we look at the period from the start of the pandemic, almost 2 years ago, to where we are now, we've had only one correction of 5%. That was in the fall of 2020, just before the election. That is it. This is all we had. So we were due for a correction, and that is what we are experiencing now. A correction, not the beginning, in our opinion, of a long bear market. And I think it's also important to understand that corrections and negative annual returns are not the same thing. And what do I mean by that? As the chart here shows, pullbacks or corrections, which would be the black diamonds on the chart here, are common and should be expected every year. As I mentioned on the previous slide, the average annual correction is around 10%. And so that would be the orange line on the chart here. And despite that, markets are up most years, as the blue bars on the chart here show. So markets recover. Markets don't stay down forever. And I think that's the important message here. And I know we all know that. We all know that, but I think it's important to be reminded of that in times of stress. So to recap, I would say that we recognize that the Fed's pivot and the Russia-Ukraine situation were likely, in our opinion, the main catalyst for this long overdue correction. But because we're not seeing the signs or the conditions of an imminent recession, we don't think we are in for a long and painful bear markets. So our recommendation is therefore to stay the course, not panic, and frankly, be prepared to add to existing positions. Another 5 to 10% correction from here in equity markets would, in our opinion, provide a great entry point for the long-term investors. Okay, 2:25, we almost up to our time here. I will conclude by first saying thank you to Steve and Ryan for your time. I want to thank you all again for attending this webinar. Again, if you have questions or simply want to explore what was discussed today in greater detail, please reach out to us, reach out to your relationship manager, or again, any of us on the call today, and we'll be happy to entertain your questions. So we will now conclude the call. Have a good week, everyone, and we'll see you next time. Thank you.